Wednesday, folks. We're going to call this Lehman Brothers Wednesday. Lehman Brothers Wednesday. So we're going to be talking about Lehman Brothers today. How many of you are familiar with the story behind Lehman Brothers and their bankruptcy? So, absolutely one, or one person. All right. So I will say we're going to talk a little bit about the subprime financial crisis. I do think that it's one of those things that you probably should, if you're not familiar with it, probably learn a little bit about it, because it was one of those events that occurred within your lifetime that had a profound impact on the way that the world operated, not just accounting and auditing. Interestingly enough, I was working in public accounting at the time the subprime financial crisis hit, and it was a night and day experience trying to explain how the business world operated at the time. So during the busy season of 2008, it was one of the busiest times that I ever had. So this is early 2008, this is occurring, and I had a couple of back-to-back 80-hour weeks, which I don't want to scare you. That's not something that's really common. It was just a really busy time. There's a lot of demand. Fast forward to busy season 2009, so early 2009, late 2008, we were just dead. There was no demand for services because companies were basically eliminating all of their value-added services because they didn't have the resources, the extra money to spend on it. And so, very interesting time. I made the joke at the time because we had just an incredible busy season. My chargeability was like 250% or something like that. Maybe not quite that bad. That would apply 100 hours. It was near 200% for several weeks. I remember having made the comments during the 2009 busy season. So what's that glowing ball of light in the sky? Because I was not used to seeing the sun during busy season. It was just one of those weird things. So as far as the context goes, I definitely recommend that you check out the movie The Big Short. Has anybody ever watched some of the old Will Ferrell films, Anchorman, Talladega Nights? Yeah, I was hoping you'd nod there, because if it was the point, there's like Will Ferrell, he's not in our generation, Dr. Barnes. I'm just like, I'm done. Yeah. So I'd say Will Ferrell comedy should span generations. But it's not actually Will Ferrell, it's actually the director, Adam McKay. Adam McKay, very, very smart man. He actually he was the director and the producer for those Will Ferrell films, a lot of those Will Ferrell vehicles. Whether you like them or don't like them, he was very, very successful. He's also done a few kind of personal projects. Probably one of the more recent ones you may have heard about, it got a lot of exposure, was Don't Look Up on Netflix. Anybody hear about that one? About a meteor hitting the Earth, and basically the presidential administration of the United States at the time basically was saying they just said, don't look up. We're going to deny that the meteor actually exists. And it's kind of it was a correct indictment of the way that kind of politics works right now. But this one was a little bit more tongue in cheek. That one was more tongue in cheek. The Big Short was a little bit more of like kind of a documentary style film that kind of retold the story of the subprime financial crisis. And while there's elements of humor in it, it does feel a little bit like kind of a modified documentary. But it's a very, very good movie. I definitely recommend it. So what happened? What happened in the subprime financial crisis? Well, basically, the housing market of the United States was considered to be the most stable market that existed in humankind. It was just basically not possible for the housing market to collapse. And the housing market was just really, really strong. And it was viewed as being one of those things that you can always be a safe bet on. And so because of this, a lot of people started saying, why don't we just expand out the offerings of mortgages to less creditworthy customers? So if you've ever gone through a loan, has anybody actually ever gone through a loan process, like buying a loan or getting a loan for a car or something like that? Okay. You're very lucky because you got that waiting for you as adults, all right? A lot of paperwork and a lot of stress. But the idea being is it goes back to the idea of risk and return. If you are considered to be a low-risk individual, then your chances of being accepted for a loan are very good, and you generally get a very decent rate of return. Now, if you're considered to be a high-risk individual, that doesn't mean that you won't get you won't be able to get a loan. It just means that you probably will not get very favorable terms on your loan. So if you've got a credit score of like 400, by the way, credit score 400, bad. Okay, don't have a credit score of 400. You're aiming for at least a credit score of 700 or higher. So if you got a credit score of 400, they may say, all right, we'll give you a loan at 20% interest. Now, I probably don't need to tell you that 20% interest on a loan is a terrible, terrible deal. And that's basically what was happening during this time period, is these very, very very, very unattractive customers, customers with poor credit history, very, very shoddy employment history, had all kinds of problems with their financial well-being. They were wanting to buy houses, and the market was such a bullish market at the time. They were being approved right and left, and the people who were approving them, they were actually actively looking for people with bad credit. Which the reason behind that is pretty obvious. If you look for somebody with bad credit, if you get approval for them, you get a much higher rate of return. Actually, they get a much higher upfront payment, but the banks get a much higher rate of return. Instead of charging like I think my mortgage is a little bit below 3%. Instead of charging a 3% mortgage on people like me, they're able to charge 10 or 20% interest on people who are just had no business buying houses. Now, what's the trade-off with that? What is the concern with that particular scenario? Why should we be cautious in that scenario?
It's a greater risk that you're just not going to pay the mortgage because they don't have the means to pay the mortgage.
Right. So if you consider that the return on that implies a higher risk, there's going to be a very high risk that these people are not going to just be able to make payments on their houses. That is in fact what happened. A lot of people basically said, "I can't afford this anymore. I'm leaving the house." See ya. Okay. There's actually a scene in The Big Short where there's these abandoned houses where people just, they just kind of got up and moved out because they couldn't afford the house anymore. And you can probably do that in Excel. You can probably figure out the market they were looking at was in a part of Florida. I don't think it was Miami. Maybe it was the Miami area. But the average housing prices in that area they were working at was like $1 million. So you can do the math. I mean, if you're talking about a 30-year mortgage on $1 million, what are the average payments on a house for that particular market? And if you're talking about something like 10%, it's ridiculous. It's like $9,000 a month. Okay, $9,000. That's a ridiculous amount of money for anybody to pay. Even if you're well off. I mean, I consider myself fairly well off. There's no way I would be able to afford a $9,000 a month payment on a house. Even if you consider yourself well off, that's ridiculous. And these were people who are not well off. They were gig workers working point to point. So. Yeah, a lot of problems with that particular model, and of course it came tumbling down. So on September 15th, 2008, that's when Lehman Brothers declared bankruptcy. The Dow Jones Industrial Average dropped by 778 points, which I realize that in this day and age is not really all that much. Okay, the recent Dow Jones Industrial Averages is kind of like, oh, that's all you got? Hold my beer. Okay. Keep in mind that the Dow Jones Industrial Average around the time was floating around 10,000 points. So literally a quarter of what it is today. The largest 30 largest companies were a quarter of the size of the companies that are existing today. So 778 points, that was almost a tenth of the entire industrial average that it dropped just because of the bankruptcy of one company. At the time of the collapse, Lehman Brothers Holdings had $691 billion in reported assets. Now, again, this is 2008, which is 17 years ago. This is still the largest bankruptcy in U.S. history. We've not had anything close. Just for comparison, Washington Mutual, which had declared bankruptcy about 2 weeks later, I believe, they actually had only $328 billion in assets. I say only $328 billion, but they were half the size of Lehman Brothers. So not only just the largest bankruptcy in history, but by far the largest bankruptcy in U.S. history. And the whole thought process behind it with these banks is that these banks were kind of the backbone of the mortgage system in the United States. And the mortgage system was so important and so prominent that it was just too big to fail. Have you guys heard that term before, too big to fail? Yeah, that's one of those things that we bandied about over the 21st century and said that. And it may or may not be proven true. It was very interesting. When I first started with KPMG, that was about 3 years after Andersen went bankrupt. We were down to the Big Four. I started at KPMG right after a big tax shelter fiasco, and there was some concern that if we had five accounting firms instead of four, KPMG likely would have not survived that particular scenario. But simply because they needed to have at least 4 public accounting firms, international prominent public accounting firms, they could not let that fall. And so that was kind of the business model that a lot of these big companies took, is that they did these shenanigans, these terrible, terrible things. But they said, it's okay because we're not going to pay the consequences before. And interestingly enough, Lehman Brothers did pay the consequences in this scenario. A lot of other banks who did some pretty awful things along those same lines did not. They're still in existence today. So some real concerns in that area. And so quick question. how did this actually happen? How did we actually get to the point where the mortgages were allowed to reach those points? So this has the philosophy of diversification. Now, how many of you all are familiar with the idea of portfolio diversification in investing? Heard that term before. So the way that I described it, and I may have described it to you all this way, it's a terrible, terrible explanation, but it's a simplistic version. I say that you invest in jet skis and snowmobiles. Okay. So if the weather gets hot, jet skis are going to sell really well. If the weather gets cold, the snowmobiles are going to sell really well. That's a terrible analogy. Okay, do not use this as an investment philosophy. By the way, I don't want to hear anybody saying, "Dr. Barnes, I took your advice. I went ahead and invested in jet skis and snowmobiles." It's not what I'm saying. I'm just basically saying that the idea of portfolio diversification is you're eliminating idiosyncratic risk or unsystematic risk in your portfolio. That was the argument that they made about mortgages. Is they said one mortgage itself is risky, but if we take like 1,000 risky mortgages, put them all into a profile that have diversified characteristics, then we've diversified the portfolio. And now, even though every single one of these mortgages is risky, the combined combination of them all together is diversified enough that it actually is stable. And they were getting like AAA bond ratings on these combinations of mortgages. These mortgages that are combined of all these things that had high default rates, they're basically saying we could sell this at AAA bond levels. So can you imagine kind of the rule there? Like you have high risk, high return, and yet you don't high risk and high return, but they eliminate the whole risk identity. And just basically, we're just going to give you high returns on that. We don't think the risk exists. That's ridiculous. That's not something that I think that we could ever approach in business nowadays. All right, so let's go ahead and get talking a little bit more about the specifics of this particular case, because that's kind of the general guidelines of what happened with the subprime financial crisis. And like I said, if you're not familiar with what happened during that era, I strongly recommend familiarity with it, because I think that that's one of those things that you probably should know about so we don't repeat the same mistakes, even though we're very, very good at repeating mistakes here. All right. So it talks a little bit in the case about investment banks and in the nature of investment banks. This was one of the arguments that about what was going on in the early 2000s is that investment banks and commercial banks, the walls between them used to be very, very defined and very, very specific. And those were starting to erode. And basically investment banks and commercial banks were kind of becoming the same entity. But it talks about the nature of investment banks, and the whole philosophy behind investment banks is they had high amounts of capital that they could actually use to finance really large opportunities. Now, this capital came at the expense of debt. All right, most of these companies operated with really, really large amounts of debt. I believe in the case it said that the debt ratio was somewhere around 30. Actually, I think that was a leverage ratio, but it was kind of skewed on what they actually said the leverage ratio was. But debt to equity would be somewhere around the area of 30, which basically means that they had 30 times the amount of debt as they had to equity. Now, what does that mean about the operations organization? It means that when they're profitable, the people who own equity, the owners of the organization, are going to make bundles and bundles of cash. They're going to make a lot of money. But when they have bad performance, basically all those good results just disappear. All the value of the equity just kind of goes wrong. So during negative years, it just basically erodes and evaporates. So you want to be on those when they're in the good years. Now, in the case itself, it talks about something called a leverage ratio. And the net leverage ratio is kind of the focus of this particular case. I'm going to be honest. I've done some research on this and trying to figure out the leverage ratio. It's easier to digest the leverage ratio by saying that it's something like debt to equity or debt to assets. But from my research on when they're talking about leverage ratio, that's not specifically what they're referring to. Those are what I consider to be traditional leverage ratios. But those calculations that they talked about in the book, these are actually on different ratios. The closest that I was able to find was basically the times interest earned ratio. It is not the times interest earned ratio. I will tell you that right now, because the times interest earned ratio moves in an opposite direction than these leverage ratios. But that was kind of the close calculation I was able to identify through my research. So what is the leverage ratio? The answer is I don't have a really good definition for you. It's a complex series of calculations that they were really not transparent about in the book or transparent about in the case itself. So the way that I'm going to characterize these leverage ratios are more traditional leverage ratios like debt to equity, debt to assets, where lower ratios tend to be more healthy performance, higher ratios higher signs of risk, because that's what's characterized in the book. But the calculation of the leverage ratio, they basically said that this leverage ratio is not a good reflection of the operating performance of the organization. Instead, they said, what we want to use is we want to use something called the net leverage ratio. And the net leverage ratio is basically saying before we actually include interest calculation in the ratio calculation, we're going to offset all of our liabilities with highly liquid assets. So anything that that's cash or could be converted to cash, which intuitively speaking actually makes sense. If you think about a leverage ratio, if we use something like debt to equity, let's say that we could cancel some of that debt out really, really quickly with really, really liquid assets. That would make sense. That'd be something we could do if we had the ability to do it. So net leverage ratio does seem to actually make some sense and is intuitively sensible. And they actually talk about the amounts in the exhibit on page 27 and show you kind of the direction that things are going. But the calculation of this net leverage ratio was kind of really important, and it was somewhat stable. It was increasing in 2007, but as was the leverage ratio. But the problem is that the calculation is, first of all, not transparent, and secondly, there may be some problems with it. Because the Lehman Brothers, they had some accounting tricks up their sleeve, and they said they wanted to actually manage leverage. That was something they talked about in the book, is that managing leverage is one of the keys to their success in business. And so they employed something called Repo 105 transactions, which are basically just repurchasing transactions. But this is a special category of repurchasing transactions. So traditional repurchasing transactions, the traditional repo agreements, they had no leverage effects. However, and this is on page 29, when certain unusual conditions were met, repo borrowers could record the transactions of sales of securities. Now, how does this actually affect leverage? I'm sure everybody was wondering about this question. It says, how does this affect leverage? And went in and created a spreadsheet to actually track these effects. So what I'd like for you to do right now is I'd like you to go onto Brightspace and I'd like you to submit, along with your assignment for today, the spreadsheets that you created as part of this activity, okay? So everybody created the spreadsheet. Am I the only one who created that spreadsheet? All right, well, if I'm the only one who created the spreadsheet, I guess that's the one we're gonna work with. Okay, so let's take a look. Obviously, I'm trolling you guys. This is just curiosity for me. I was just curious, how on earth does this affect leverage? And so this is a very simplified version of this particular activity. I'm not going to say that this is correct activity, but this is a way to think about it. And like I said, I'm going to characterize leverage through debt to equity, debt to assets, because their leverage ratio is not transparent, and it's just easier to calculate this. So say we have assets of $10 million, and liabilities of $8 million, and equity of $2 million. And obviously, these are not. This is not what was in place at Lehman Brothers. These numbers would be astronomically larger. But I wanted to do something that was simple for calculation purposes. So if we're talking about that debt to equity, then we're talking about liabilities of $8 million, equity of $2 million. So we're talking about a debt to equity of 4, which not bad. Again, we think that Lehman Brothers was substantially higher than this. And debt to assets of 0.8, because 8 divided by 10, which these are actually, these are high. What would I think for a traditional organization? Not as high as what we were looking at for investment banks. Investment banks would have much higher ratios. More traditional organizations have much lower leverage ratios. So in the scenario that we have a conventional repurchase agreement, basically what happens is that there's going to be a repurchase, and then the proceeds from that repurchase are used to pay off existing debt. So how would that work? Let's just use a very, very simple mechanics, okay? I'm not even looking for specific accounts. I'm looking for generalization of accounts. So I'm going to say I'm going to generate assets, okay, from the sale of a debt security. So I'm going to get cash, so they're going to characterize this as assets, the sale of the debt security, and we'll say this is going to be for $1 million. And we can say that that's probably characteristic of a traditional debt security, right? If you sell a debt security, if you issue a debt security, you generate cash, which you're going to use for the purpose of investment, and then you have this liability that's payable, this bond payable or whatever long-term debt that you generate. But that's going to basically equal $1 million. Now, again, in the book, it said that this $1 million, this cash that was generated here, was going to be used for paying off existing debt. So if that's the case, then we're going to pay off existing liabilities to the tune of $1 million, and we're going to use the assets we generated above. All right. So what is the net effect on the leverage ratios of this transaction? Well, we generated $1 million in assets, but then immediately got rid of it. We generated a liability of $1 million, but that was offset by the $1 million that we pay off. So the actual answer is there's no difference whatsoever. There's no change at all. Okay. So does everybody see why when we talk about conventional repo agreements, why there's no leverage effect? Does everybody understand that? Basically, there's no change, okay? This is a transaction just for the purpose of refinancing or repurchasing debt, okay? And so I think that's a pretty traditional transaction. Now, where it becomes weird is where we think about the repo 105 agreement. Now, the repo 105 agreement is definitely going to generate more assets for us, okay? Because we're going to generate assets. But what did we say was the characteristic of repo 105 agreements? Under certain conditions, under certain unusual conditions, they can be treated as sales. They can be treated as sales. So instead of recognizing liabilities here, we're now recognizing sales revenue of $1 million. All right. And then we use these same assets to pay off liabilities that exist. So the same transaction exists as we saw before, $1 million. Now, can people see this subtle difference that exists here? I know this is a simplified version, but it's really important to understand is that we are basically generating a sales revenue that offsets a liability. So we have a reduction in liabilities of $1 million, which means our debt to equity goes down to 3.5 and our debt to assets go down to 0.7. Now let's just think about this logically. Is there any structural difference between these two transactions, these two series of transactions? Does this transaction and this transaction effectively, are they basically the same transaction? Yes. The only difference is how we characterize it for purposes of classification. Under certain unusual conditions, they can actually record this as a sale of securities. Now, as an auditor, I would be looking at this and I'd be saying that doesn't make any sense because we're basically treating a liability generation as a sales revenue, which one we tend to think is a bad thing. It's an obligation for the future. Another one we think is a good thing. That's the lifeblood of the organization. That's one of those basic things that we think about back in 220. That's the very first thing you ask your professors is, wait a minute, liabilities are going to be credits, but sales revenue are also credits? I don't understand. That doesn't make sense. How many people ask that question, at least in your head? See, one of those accounting tricks, nobody asks that question in their head. This is like a question I've asked, like for 30 years of accounting, I've been asking this question, okay? Doesn't make any sense to me. If you haven't asked that question, you don't ask enough questions, guys, okay? So why do we do that? It's the same thing for assets and expenses. Why are assets debits and expenses are debits? One's good, one's bad. Why are we treating them the same? The answer is that's just the way accounting works, okay? Which is not a very satisfying answer. But because of accrual-based accounting, we get this conundrum. We can offset a liability with a sale. All right. So the argument was basically that this was legal under generally accepted accounting principles at the time. Sounds like another argument that we said that was justified by GAAP. Does anybody remember another company was doing similar shenanigans that they said this is legal under GAAP? Has a big letter E at the very beginning of their name. Enron, yeah, good old Enron. They were saying those special purpose entities, those were legal under GAAP too, okay? But that was the argument for it. And there's actually a very famous accounting professor. His name is David Albrecht. He actually has a blog that he runs. He was talking about Repo 105, explaining the numbers in detail. And his ultimate conclusion is that this is justified because it's GAAP legal, all right? If FASB has a problem with these transactions, then they should actually not make these rules under GAAP. And if auditors has a problem with it, then they need to make sure that this is they're clear that this is misleading. But making the argument that's legal under GAAP, that's the ultimate justification. Now, what do you guys think? Do we use GAAP as the ultimate justification? I mean, should we use GAAP as the ultimate justification for transactions under financial accounting? I mean, in this classroom, it's very easy to say, well, no, Dr. Barnes, obviously this is problematic because this led to the $691 million bankruptcy, okay? But it's not really all that simple. So how do we actually make the justification, okay? So can we say Repo 105 transactions are at best window dressing? They're just accounting tools. That's one of the arguments, the questions you have to answer is they're accounting tools. But at the worst, when we talk about Repo 105 transactions, then those are going to be materially misleading. We actually have guidelines under generally accepted accounting principles that talk about this. We say that if they're materially misleading, you should not follow GAAP. So the rule is that if using the use of GAAP in a certain scenario would mislead users of the financial statements, then you may actually follow procedures that are not applicable to GAAP. If doing so would cause users of the financial statements to be misled. So GAAP actually has an exception for situations where use of GAAP would be misleading. And I think that's kind of the argument is made. And we actually talk about that. We talk about that concept with respect to accounting. We actually say, do we follow the rules or do we follow what the rules or what the guidelines should be? We have this concept of substance over form that we've talked about in this class. The form is generally what we tend to dictate to, we follow the rules, but maybe we should think about the substance of the transactions. All right, let's go ahead and get into the questions. When Lee was developing its 3.105 accounting policy, did EY have a responsibility to be involved in that process? In general, what role should an audit firm have when a client develops an important new accounting policy? Comment on an audit firm's responsibility during and following that process. Okay, so I'm trying to remember whoever it was. I think Madeline, were your group one? Okay. So what'd your group say on this one?
Yes, E&Y should review the policy and ensure that any changes in the company's operating environment should be assessed for the level of risk associated with one. E&Y should also monitor the implementation of the accounting policy to ensure it is being used appropriately.
Right. So I think there's a really good argument to say, look, we've got the EOI should be supervising this. Now, the question starts out with the question, or it starts out with the query. Should EY have been involved in the development? Okay. Now, how many of you all think that EY should probably be involved in the development? This is a personal question. I'm not singling out any one individual. Okay, if you don't raise your hand on the next one, I'll be very angry at everybody. Okay, how many people do not think EY should be involved in the development? Okay, so everybody's like, I'm gonna raise my hand now. So you have to take one position or the other. You can't just stay outside. I don't know, Dr. Barnes. I don't know, I guess is a fair statement in this one. Because honestly, there's arguments for both. I think that there's an argument to say that they should have been involved in the development, because if they weren't involved in the development and then came in later on and say, yeah, this is not cool, you can't do this, then Lehman Brothers would have been blindsided. So we've already set up our transactions like this. You can't make us go back and restate this. Yes, we can. We're the auditors. All right. So maybe they should have been involved at least in some capacity at the beginning. But that's let's talk about the counterpoint. If they're involved at the very beginning at the actual development of the transactions, could that be construed as an independence violation? Yes. And I think that's the ultimate justification for why they probably shouldn't be at the beginning. They definitely need to be involved at least in the audit process and the evaluation of these. But in the development, that's a little bit of a suspect proposition. I think there's arguments for and against, and I'm not sure what the answer is, but you could actually choose your own adventure on that one. Go down whatever path. All right. Do you agree with the assertion that intent doesn't matter when applying accounting rules? That is, should reporting entities be allowed to apply accounting rules or prohibit exceptions to accounting rules for express purpose of intentionally embellishing the financial statements or related financial data? Defend your answer. All right, Maddie, defend your answer.
We actually said it depends on like if intent matters.
That is a great answer. That's always the answer that's going to be correct in this class. So gold star for you for saying those two words, but justify your position.
Technically, if a client is following the accounting rules, then like the intent doesn't matter. But we also said that like embellishing financial statements isn't necessarily wrong as long as they're in compliance with like rules and regulations.
Yes, so one of the important things to note has to do with the idea of rules. I keep using the term GAAP, generally accepted accounting. What is that last word? Wait a minute, are we a principles-based system in the United States? Oh, absolutely not. We are a rules-based system. You've heard me harp on why. Why are we a rules-based system in the United States?
Very litigious.
It's very litigious. I think he's down the hall, but it's all Scotty T's fault, okay? It's all the lawyers' fault. We're a litigious society, the most litigious society on the planet, okay? So we tend to operate by something called precedent, okay? I think we've actually talked about precedent before in other classes, but if we haven't, we're actually going to be talking about it in forensics in very, very near future. But we're going to operate by something called precedent. And so precedent basically says that if something works in one scenario, it should work in all scenarios. It's kind of a universal maxim principle. Doesn't really actually consider the circumstances of every single scenario. Under IFRS, they tend to be a true principles-based system, which basically means that if you can justify your accounting treatment with a reasonable approach, then it's going to be fine. But they're not nearly as litigious. They're not going to be if we follow the rules and there's a problem, or we follow the guidelines and there's a problem, we're going to sue you. That doesn't occur in most European countries or countries worldwide. It occurs all the time in the United States, which basically means that we have to have our I's dotted and our T's crossed in every single scenario. How much justification of there is this? Okay, so if I printed out all of the generally accepted accounting principles, okay, actually let me use IFRS for context. Okay, if I printed out the IFRS principles of financial reporting, it would be a 2,000-page document. Okay, how big do you think generally accepted accounting principles would be by comparison? Same font, same number, or same spacing. 25,000 pages. Okay, literally over 10 times larger than IFRS principles. So it's very, very clear that we have a lot more detail, a lot more requirements that we have to follow. So basically, in the United States, our guideline is going to be, does it follow the rules? And the answer is yes, we use that. If it doesn't follow the rules, the answer is no, we can't use that. Even though generally accepted accounting principles does provide that circumstance for departures from GAAP, it's very, very rare that it happens. In fact, one of the old Becker instructors, he actually talks about this during the audit section. He says, GAAP provides for departures from GAAP. He's never encountered it the entire time he has performed audits, but it does exist. So if he's been performing audits for like 40 plus years and never encountered it, how frequently does it happen? Answer is generally never, okay? Which is certainly problematic if we're trying to operate from a principles guideline. All right. So question number 3, do auditors have a responsibility to determine whether important transactions a client are accounting motivated? Defend your answer. Colin, were you group 3?
Yes.
Okay, so lay it on me.
You said that auditors should be responsible to act with professional skepticism, but might not take on the full responsibility of identifying whether they're accounting motivated or not. And then we said auditors should ensure that the transactions reflect economic substance in order to maintain transparency rather than performance. Basically, the fact of the transaction matters more than the motivation of someone's actions.
So are you arguing substance over form?
Yes.
Okay, good for you. I'm glad somebody took a stance on that. Yeah, I would argue that that's ultimately the case. That's kind of the responsibility of auditors, is to say, look, did you follow the rules? Yes, but this is really misleading. Your leverage ratio is not 16.1. Your leverage ratio is 17.8. Okay, and it doesn't really matter that you can do these accounting tricks, and these accounting tricks are perfectly required under GAAP. You basically are just bending the rules for your own benefit. All right. Now, you probably had this occurrence in your own life where somebody is basically, they followed the rules, but you said that's really unfair. It's unfair that you get to do that in that scenario. And somebody kind of misinterpreted the rules to their own benefit, and you said, yeah, I don't agree with that, but you did follow the guidelines, and it's still unfair. It doesn't change the fact that it's unfair. That's kind of the truth when we talk about Lehman Brothers accounting treatments, using these repo 105 transactions to disguise it, especially the fact that there was lack of transparency, which is something that Colin pointed out. There was a lack of transparency in the information that was provided. There was no guidelines about how the net leverage ratio was calculated, and so it was really not transparent as to what the number came from. And the question was, could you use the financials? Could you use the financials that was provided by Lehman Brothers to come up with those same numbers? The answer was no. People could not actually perform those calculations on their own. These were actually leverage ratios that were only published in the annual reports because they were trying to convey a sense of assurance to the investors. So certainly problematic in that regard. All right. William Schlicht and Paya, the EY British affiliate, had the responsibility for reviewing the legal opinion of a British law firm regarding the treatment of repo 105s as sales securities. Do you believe that Schlicht or one of the subordinates should review that letter? Why or why not? In general, how should the responsibility for different facets of multinational audit be allocated between among the individual practice offices and the engagement? Kyle, I believe you're a Group 4 leader.
Yep.
So you consider yourself an expert on multinational lawmaking?
Not.
Okay, so we're going to talk about this from a very, very blunt perspective here, because I'm not either. But what was your group's perspective on this one?
We said that the British law firm had the responsibility of reviewing for the British company. However, E&Y still needed to review it for the American company. As such, they should have reviewed and determined whether or not the transactions were appropriately recorded. In general, firms should be responsible for making sure that transactions are recorded properly for their own nations.
Right. And so I think this interchange was certainly problematic in this scenario, because the fact that Lehman Brothers could not find a domestic law firm to issue the type of ruling that they were looking for in this particular scenario does raise a lot of red flags if you're the auditor. You're going to be saying, well, all right, this legal opinion with respect to treating repo 105 as sales securities, how does this actually align with the way that we should view accounting treatment? And the answer is it really doesn't. Okay, doesn't matter if it's required, if it's legal according to GAAP. From a complete and total common sense perspective, that we should actually take some guidance in the fact that domestic firms were not willing to actually take liability for this. So the fact that there was a international multinational firm, I'm not saying that multinational rules are not applicable. We've actually seen that in recent memory, where the SEC has said that companies who issue according to provide financial statements according to IFRS can actually be audited under PCAOB guidelines. So there is some dynamic saying that international rules can be applicable to U.S. domestic standards. That being said, there does need to be a lot of scrutiny in that regard to make sure that the quality and the caliber of the opinion being rendered is consistent with what we would see in the United States. In this case, there was a big divide. If you can't find a domestic firm that's going to issue that opinion, then that maybe that signal the opinion should not try to be forward. All right, question number 5. Lehman's net leverage ratio is not reported in the company's audit financial statements rather than the financial highlights table in the NDA section of the annual report. What responsibility do auditors have to assess the material accuracy of financial data included in the 2 sections of the client's annual report? Madeline, what do you think?
We said auditors must read the financial statements and ensure that the information is presented fairly in all material respects, including MD&A.
Right, so keep in mind, we as auditors are not responsible for auditing or even corroborating the information in external documentation, like in the annual report. However, we do have to make sure that it is materially consistent with the information in the financial statements. Now, when we talked about this back in 417, the idea was pretty simple. You can't say that you had $1 billion in income when you had $1 billion loss, all right? Is this the same thing in that scenario? Because we're talking about in this particular scenario, we're talking specifically about the calculation of net leverage ratio. And that's not any information that's given, there's no information given on the calculation of leverage ratios in the audited financial statements. So this is presented in the annual report, but not presented in the 10K. Should that have been a warning sign or something the auditors looked at and say, well, why wasn't this included in the 10K? It seems like it's relevant investor information. It's relevant to stakeholder information. Why are we just seeing this in the annual report? So that kind of, to me, signals that there's some sort of inconsistency. There's some sort of problem with the nature of this report, the nature of the reporting information. The fact that we can't actually reverse engineer it and come up with what that leverage ratio actually calculated from based on the information that's either in the annual report or the financial statements. So how do we actually make sure that it's materially consistent? The answer is that I don't think anybody than an auditor could, okay? The auditor has access to the financial information of the organization at the time of the audit, but somebody who is on the outside looking in, such as the owners, the investors, other stakeholders, would not actually be able to determine where that whether that those leverage ratios are consistent based on the information provided. So if that's the case, should the auditor step in and say, this is not transparent enough, you need to provide greater transparency as to how these ratios are calculated? The answer is probably so in retrospect, but that's a little bit of a difficult proposition to make. All right, question number 6. The Repo 105 transactions reduced Lehman's net leverage ratio from 17.8 to 16.1 at the end of fiscal year 2007. Do you believe this was a material difference? Why or why not? Maddie, what did your group think?
You said that it was material, or it was a material difference, like 10%, like a 10% decrease.
Mm-hmm. So on page 32, it says materiality is usually defined, and this is specific for this organization, for this audit. Materiality is usually defined by any item individually in aggregate that moves leverage by 0.1 or more, which was typically 1.8 billion. Boy, isn't that something really nice? Your organization, it says, yeah, we saw a misstatement of 1.2 billion. It says, oh, that's not even in the realm of the ballpark. Yeah, and we don't even care about that because 1.8 billion, that's our materiality threshold. Ridiculous. So repo moved by leverage by not by tenths, but by whole points. Okay. So basically we're looking at the full point differentials, which Maddie said was going to be kind of about, I think it was roughly 5% of the overall total assets, but 10% of the total income. So substantial amount. And I think that we can actually, if we interpret this, again, the transparency of this particular data is suspect. I'm not sure that I can actually say, I know exactly how much this is stated by, but according to my calculations, we were looking on the magnitude of like $30 billion. Even if we say that this organization was so large that $30 billion may not have even been considered to be a drop in the bucket, how many people in this world do you think are going to look at a $30 billion misstatement and say, yeah, that's not really all that much? I think I'd have a problem with that. I think I'd have a real problem with that, even if we don't even think about it as material relative to the size of the company. Materiality in the realm of just a reasonable user of financial statements, I think we're going to say that. I think anything over $1 billion, most people would say, yeah, that's a lot of money. That's a lot of money. So yeah, some concerns there. And by US criteria, the repo quantified transactions, they represented a material difference according to their criteria, at least the way that I read it. That gets a little bit suspect. It's not transparent as to what that amount actually was. Question number 7. In general, what responsibility do auditors have to investigate whistleblower allegations that relate to the material accuracy of an audit client's financial statement? So going on a little different tangent, because there was a whistleblower complaint that was initially investigated and then basically ignored after that. And we've seen the issues of whistleblower complaints that have come up. Colin, what'd your group say on this one?
You said that the auditor should be responsible for investigating like the reliability and fairness of financial statements, and that serious allegations need to be reported to the audit committee, especially if these allegations involve people higher up in the organization. And if auditors chose not to follow up with any allegations, it can be seen as negligent or reckless. Auditors have to do like their due diligence to make sure that the financial statements aren't misstated, even if that includes something from a whistleblower.
Good. So you actually made an important point there that I wanted to kind of highlight. So you made the comment that if auditors fail to follow up on a whistleblower complaint, that it could be viewed as negligent or reckless. So that was kind of the legal criteria that we talked about in our previous case when we talked about, I believe it was health management. We were looking at the PSLRA. So remember under those guidelines that the auditor had to be a knowing conspirator in the fraud or a knowing conspirator in the activities. Let's say that you are an auditor, you received a serious whistleblower complaint, you follow up on it, you believe there's some basis there, but you're just really, really insecure about it because it might compromise the integrity of your audit. So you basically ignore it. Could that be considered to be more than just negligent or reckless in that particular scenario? Could we have said that that might compromise independence with the client if we fail to follow up on something like that? Could we even say it goes so far as to actually meet that criteria that we saw in the previous case, where we say that it might be a knowing participation in a fraud? Maybe not on the front end, but on the back end, if we just ignore a whistleblower complaint of that magnitude. Now, yeah, this whistleblower complaint, I think, is a little bit more, it's a little bit more opaque than some of the whistleblower complaints we've seen in other cases, particularly one in the Enron. I think one in Enron was very obvious because Sharon Watkins was a high power executive, and she made some very, very specific criteria, some scathing criteria in her complaint. In that particular scenario, we could say the whistleblower was just ignored, and I don't think it was ever brought to Anderson's attention in that particular scenario. This one was brought to the auditor's attention and was investigated, but for whatever reason was not followed up on. So I think that the negligence or the recklessness or negligent criteria would be more appropriate here. But even so, if we think that the whistleblower complaints are serious, then that's something that we have a responsibility to do as auditors to make sure that we follow up on. At the very minimum, we're going to be held reckless or negligent. At maximum, we could actually be liable for the scenario, which that would have been problematic because given the size of the bankruptcy, that probably would have bankrupted EY. So EY is a defendant in the Lehman-related lawsuits in both state and federal courts. Identify the factors that influence legal exposure between lawsuits filed in state courts versus those in federal courts. This is kind of an interesting one. You may have to do some digging on this one. So, Kyle, what's your group come up with on this one?
We said that state laws allow for a broader range of liability for CPA firms, most considering negligence as the threshold to be held up for liable for incompetence. Whereas federal courts and regulations have ruled that intentional fraud and misstatements is required to hold a CPA firm liable for an audit of misstated financial statements.
Very good. Yeah. So state firms tend to be a little bit more broad as to what they will allow with respect to liability. Federal suits, they tend to be generally centered on violations of laws and regulations, particularly those that affect capital markets. That tends to be a very, very big criteria for federal lawsuits, is the ones that affect capital markets. When I say capital markets, what I mean, I'm talking about investing and debt and all of the things that are used to generate capital for organizations. So if there's any violations of the rules that the SEC pronounced or any of the other legislating bodies in this area, that's going to be something that's focused on federal bodies. With respect to state lawsuits or state actions, they can actually be a broad range of stakeholder impact. Anything that we think that the CPA firm violated that might actually be a conscientious violation of stakeholders in the organization, not just investors, not just creditors, but anybody who had a vested interest in the well-being of the organization. I suspect that a lot of the suits that EY was held accountable for in the Lehman bankruptcy were held at the state level simply because there was such a broad array broad cascade of effects that occurred as a result of this. Again, it had an international impact. It affected the Dow Jones International Average by a big amount, and kind of led to a failure mechanism for the U.S. markets that lasted for multiple years. So this was kind of the precursor, and it was a dark point in U.S. history. Thankfully, we're past it. We're never going to suffer any dark points like this ever again. We're never. Oh, wait. I'm sorry. My bad. I forgot what date it is. All right. All right. So yeah, that's Repo 105's Lehman Brothers. Hopefully you got something out of it, and you're ready to go home and just watch the rest of The Big Short and learn all about the wonderful world of subprime mortgage rates. All right. CPA prep on Friday, as well as a quiz and the next book club reading. So I'll see you all then.